serves as the global chief economist and a strategist at Manulife Investment Management, and we are pleased to have her here with us. Nice to see you.
Nice to see you, John.
Never a day where we're not digesting economic data on any economy around the world, but it's nice to have both the U.S. and Canadian economy in focus right now, and the stock market's attention very keyed in to all of this. Generally, when you look at the economic numbers, whether it's Canada or the U.S., is there something that's sort of the big theme that's keeping you sort of glued together of what the market's trying to figure out right now?
Market's trying to figure out, are we going towards a classical recession or not? And if we are, what will central banks do in that situation, especially because inflation, while coming down, is not quite back to those 2% targets. Now, Canada has a little bit more of a leg to stand on when it comes to rate cuts. The data is, unfortunately, much weaker here at home than it is in the United States. That's why the Bank of Canada has said to us, a pivot is on its way. Is it next week? We think so. Could be July. But we know we're shifting towards easing. The Fed in a little bit of a hotter situation. Their jobs numbers just really strong. Their economy not showing that weakness just yet. So they're on hold a little bit longer. And I will say, you said North American economies, but the rest of the world also engaged in the beginning of an easing cycle. Europe probably going to cut rates next week. So if you're a tactical trader and you're looking what the next 6 months theme is going to be, I think you're going to be talking about the U.S. diverging from the rest of the world just a little bit more when it comes to cuts versus holding. If you're looking out over a year, you probably got to factor in that recession risk more than is currently in there. If you're looking out over 3 to 5 years, you know what? This is all distractions. Focus on those long-term rates heading back towards 3% over that time. A proper asset allocation. A lot of this commentary over the 3 to 5 year horizon less relevant to you than maybe over the next 6 months to 12 months.
Okay, well, all fair points. And before we get more into the long term, just coming back to the short term, I think coming into this year, or maybe go back 6 months or 8 months ago, that idea of the recession risk was definitely constantly part of the narrative, and people thought that you might have seen a pivot to rate cuts faster. So I guess against that backdrop,
what happened?
What happened? Thank you very much.
So 100% of economists at the end of 2022, surveyed by Bloomberg, were calling for a recession in 2023. It didn't materialize. And so what's happened is people have said it didn't happen, therefore it won't. Now, there's a couple reasons we didn't get that forecasted recession in 2023. One is econ models just didn't behave as we would have expected them to. One issue is we're still in a post-COVID economy. So the interaction between manufacturing activity and services activity is just not doing what it used to. There's still a really strong preference from consumers towards services activity. We use the example all the time, but it's just true. Taylor Swift, I was going to say conferences.
She could do it.
She could do it. I would attend. Taylor Swift concerts, for example, restaurant activity. So the behavior that we anticipated from consumers didn't materialize. The second big issue, huge amounts of pro-cyclical government spending. Governments globally, but also in Canada, have been keeping this economy afloat. More so that if you took an Econ 101 class, you learned about Keynesian economics. Governments, we were told, spend in bad times, pull back in good times. That didn't happen. It broke our economic models. A couple other things around the sidelines. But I will say, the average time from the first rate hike to its impact on the economy is 2 years, John. We are now entering the window in which we would traditionally see rate hikes impact your economy. That's why the Canadian economy is losing a lot more momentum right now. And I think that even though we were wrong in 2023, you got to come into work, look at the data as it is now, forget your priors, and say, what is the main point of the data? The data continues to tell us that recession risk is higher. It's just uncomfortable to say it if you've been saying it like I have for 18 months.
And what about what makes sense to say about inflation itself, which I think at the end of the day was one of those balancing acts anytime we were worried about recessionary risks?
Well, if you want to play the throwback game 4 years ago, we were talking about, is inflation supply side or demand side? You had to pick a camp. Turns out it was a little bit of both, or a lot of both. Inflation globally is coming down. In fact, in emerging markets, it's effectively solved. It's back to pre-COVID levels. In developed markets, a little bit stickier. A big part of that is just the unwinding of the post-COVID supply chain issues. I think we are emphasizing just how much we are still in this distorted post-COVID economy, but it's coming down pretty quickly. In places like Canada, where interest rates bite more, the demand side to inflation is also coming back. That's why we have inflation in Canada back to 2.7 on a headline basis. That's within the Bank of Canada's target. It's not 2% the target for the Bank of Canada. It's 1 to 3, with the midpoint being 2. In the U.S., their economy is still a little bit hotter. They haven't seen the same decline. They got to wait a little bit longer.
And then going longer term, which you were alluding earlier, you think all signs are pointing to eventually lower rates, and that's something to consider for one's portfolio.
Oh, we are absolutely at a tipping point when it comes to monetary policy. Now, remember that usually the Federal Reserve is the first to move. The U.S. is the first to move. The rest of the world follows. We're in a peculiar environment where actually the U.S. may be close to last. I think the Reserve Bank of Australia might hold on a little bit longer. The Bank of Japan still hiking. But if my long list of global central banks, the U.S. probably will go near the end. But there is no question, rate hikes in almost every major economy over. We're heading towards rate cuts. But I don't think the main question is, is the Bank of Canada going to cut in June or July, or even is the Fed going to go in September or December? The question is, how big will that easing cycle be? If it's 1995 type styles and we're only cutting 3 or 4 times, that's a very different investment prescription than if, for example, in our base case, we're going to a proper easing cycle with 200 basis points of cuts and heading back towards 3%.
In that kind of environment, what would historically happen?
Historically, if we have a garden variety recession, then we see garden variety easing, which means going back to what we call the neutral rate. John, I know we talk of this very economist type conversation, neutral rate being the rate that is neither tightening nor easing in the economy. That's probably higher now than it was before COVID. So going back to 2%, 1%, probably not likely, but back towards a neutral of 3, that seems like the most probable outcome in our outlook.
Okay.